Now, as we finished off the last segment, we want to look at housing a bit, because this is where we've been talking about kind of that next leg of CPI pressure is going to come from. It's 42% of the CPI calculation, and we're continuing to see that trend higher from a rent level, from a home level, but the unaffordability side. So this is looking at housing affordability gauge has now surpassed the 2008 level, just to see how parabolic it's gone in the last quarter, which leads to what we talked about in the last segment, where the buyers are balking. They're like, this price doesn't make sense anymore, and sellers are sitting there saying, well, why is stuff sitting on the market a bit longer? It's still moving in a certain direction. You're still seeing sales because there's a shortfall of supply, but there's more concern that continues to come through the underlying system, which again leads to some of those problems that we continue to see. And as these prices go higher, again, that's going to feed down into, well, how do we calculate CPI? How are we going to calculate the largest piece to what people spend on a monthly basis? Now, from a healthcare perspective, I spend more on healthcare. I know others do the same. So in terms of where these weightings are, again, I think they're still remaining correct. But just to give you an idea of where some of these pressure points are, housing being the biggest one. And average rents rising most across large metros. So this is showing just the level of rent increases throughout this period that have yet to find their way into the CPI calculation. So we're up either 15% to 45% from this level, which is going to be base effect. Now this is where I will 100% say there's base effect, but when you average out over the last 3 months, you've had a huge acceleration, because again, these are things that are going to continue to drive that level higher, which is why inflation is going to be stickier than obviously what they're saying, which is what Powell is now coming out saying, that has been underestimated and could be higher and longer than they expected. So high-end home sales still outperform. You're still seeing this level of high-end and affordable, but that mid-price range, which has always been a little bit more on the difficult side, is come back under pressure. And that's where we continue to see some of these year-over-year levels, where the affordable side, and this speaks to flippers, people that want to downsize or take advantage of the fact that they can sell their homes for so much more. So you're starting to see some of that affordability price their way up, where the high end has been fairly strong, but there's some bifurcation within that, just given location and where some of these shifts are, because high end in Ohio is still going to be cheaper than high end on Long Island. And what does that mean when you transition? So it's also going to come down to, how do you quantify what is high end and by location? So when we look at U.S. new privately owned home units started by structure, you can see that it's starting to come up a little bit, but private housing permits have come under a little bit of pressure, because you're looking at this catch up where the commodity prices have run so far ahead of the market that a lot of builders have pulled back. They're like, look, I'm going to wait for the market to catch up. I can't pay these prices because I can't increase my price $28,000, $35,000 to the end user. So I'm just going to wait for things to cool out. I'll sit on my permit, and then once things normalize, I can get a better price on raw materials. Then I'll turn around and start building. And that's why you're starting to see a little bit of this slowdown in terms of permits and new structures. So then when we turn to private housing units started by structure monthly, here's where you see some of this slowdown, but now you're starting to get a little bit of a tick back up. Things have gotten a little bit better in terms of, lumber coming down again, some of these moving, but building permits are coming under pressure again. So this is where we're going to continue to see some of these pressure points, because there's still a supply shortfall. So you still have a certain amount of demand. Seasonally, people buy homes in the spring and summer. So this is going to continue to get things moving, but what happens when mortgage rates go up, as we've seen with rates going up right now? How is that going to impact the next incremental buyer, instead of having them go out and purchase a new home? And now when you look at, congratulations, we've done it. Stocks as a percentage of household financial assets have hit an all-time high. So when you look at it in general, Pension fund entitlements have been subtracted from the total financial assets of household and personal trusts. The results help to identify those assets that households may have more immediate control over. Therefore, this series is more likely to signify individual investor equity investment levels. Regardless, even if there's a margin of error, you can get an idea that we are at the highest ever of 45.7%, taking out the tech boom of 44.5%. So congratulations, meme stocks are here and they're here to stay. And here's where the amount that has been in the market in general over the last, over the last couple of years. And if you think about bonds in general and the negative yields that they've had, it makes perfect sense. Like you're essentially going to go down that risk profile, and in order to essentially buy, riskier assets, which comes down to equities, which is why we're seeing a huge surge in equity purchasing. But at the same time, when we start looking at the internals of the underlying economy, that's when we start looking at the Empire State Manufacturing Survey, which has continued to start, came down again. So it's still positive. It's still growing. But again, you're seeing that employees slow down. You're seeing some of those slowdowns that are persisting through the system, speaking to when do wages go up? How are you hiring? Maybe if you can't hire someone, you're going to slow down a bit. What are your raw materials? What's your inventory? All of those things that we touched on the earlier segments. So then when we look at the 6-month moving average, so this is what we keep talking about. Takeaway, let's look at 2021. So let's only look at 2021. And here you can see the general increase in terms of that movement of over 2% across all levels, generally continuing to drive higher as we continue to see these projections going into, because when we look at that PPI final demand, so May PPI hotter than expected at 6.6% year over year versus the 6.2% estimate, and then core positive 4.8% year over year versus 4.1% in prior months. So again, these things are going to continue to drive that level higher on the cost side, which then filters down into price. So then when we look at US CPI versus US PPI, you can see just how much cost has yet to find its way into the CPI calculation. Now, will all of it find its way in? No, it won't, but you'll see a huge makeup as companies look to make up for the fact that they need to get paid for what they've been taking the risk on, what they've been having to face in the supply chains, and these are places that continue to see a level of increase. So then when we look at U.S. Treasury issuance, so this is what we were talking about with rates. So U.S. Treasury issuance versus Fed QE and foreign inflows into U.S. Treasury securities, where the Fed was buying more than what the Treasury was borrowing or issuing. So the funding gap was actually negative, which is why even though we had these massive inflation beats or surprises to the upside, you didn't see the same type of reaction in the 10-year or in Treasuries in general, just because you had the Fed just sitting there as a net buyer, just buying up whatever was there, keeping a cap on a lot of those rates. So then when we look at the 10-year bond yield, this puts it into perspective. So when you look at this red arrow here, so the red arrow is QE, so quantitative easing is less than the issuance, which means that the Treasury's borrowing more and rates go up. Then the green arrow is when QE or quantitative easing is above the issuance, and you see this massive pressure. So that does reverse in Q3, which again, between what the Fed has said today, the inflation rates that we've seen, the inflation yet to come, as we look at, because remember, cost becomes price, price is inflation. So again, that's where we continue to see things going higher. And now just looking at things in a little differently on a month over month level, PPI at 0.8% and core at 0.7% in May, hotter than expected, given that goods were positive 1.85%, core goods 1.1%, food 2.6%, energy 2.2%. And that's when you continue to see this move higher. Services at 0.6%, broad-based with 40% from margins for auto retailing. That's where the core goods and the services are going to flip and provide some of that surge to the upside. And then headline PPI, as we said before, 6.6% and core inflation of 5.3%. All of these are going to lead to just that drive higher. And when you think about core goods, if you buy a home, well, when you buy a home, you're not just buying that asset. Well, do you need a refrigerator? Do you need a new washer dryer? The ancillary things, sofa, TV, furnishing the new space. All of these things come into the cost of the home. So not only are you buying the house, but all of those ancillaries, which just increase the total cost of moving, especially if you either are trying to fill new rooms because you're expanding, because your family's growing. All of that leads to additional pressure on buying. And this is showing just U.S. producer prices continuing to go higher overall, just to give you an idea of the growth metrics that we've seen in general, which are showing up in retail sales, which disappointed in May. So core retail sales, fell, total retail sales fell. And this is that pivot where on the bottom side, you can see a lot of these slowdowns in, again, furniture, home furnishings, housing, general merchandise stores, electronics. A lot of these things are seeing inflationary pressures due to shortfalls, due to displacement. And some people are like, look, I'm not going to pay for it right now. I'll go to food and beverage. I'll buy a little extra. Gasoline stations are going to go up. People are buying a bit more on the grocery side. This is going to continue, and this is why without any new stimulus coming through, without some of that, we're going to continue to see those retail sales continue to miss. Now, U.S. Treasury deficit actually came in below estimates, where it was actually not as bad as expected. Because remember, taxes were delayed, so tax receipts were up. That enabled for a nice little increase, so that, or I should say, a less bad number. Let's put it that way. Even though we're still much worse than 2020. Then when you look at, kind of rounding that out, University of Michigan buying conditions for houses and cars is the worst since 1982. So when you think about people and the way they're going to spend money, they're essentially telling you that I'm going to wait. Like, I'm going to sit on what I have. I'm just going to wait to see how this plays out, because I don't either have the cash to buy it right now, because in order to get a meaningful down payment, I'm going to have to save. Saving's getting harder because of the fact that I can't invest anywhere outside of meme stocks to make any money. So here's where you're going to continue to see this shortfall. And as this happens, that's where you're going to see that slowdown in the consumer purchasing, which is when you start looking at the Federal Reserve Bank of Cleveland. So they're starting to see that little tick up, and that's using the medium CPI. So trying to take away the top, highest, and lowest, trying to get this level. But the urban consumer continues to shift higher. And that's why when we look at what the Federal Bank of Cleveland is showing, you can see that it started to turn up, and just based on not only just food, but also housing and healthcare, all of that is going to continue to support that move right back up to 3% over the coming months, which is going to continue to make a lot of those pressures increase over time. And again, based on housing affordability, the unwillingness to pay up, now you're starting to see this buyer-seller strike, where it's just a buyer strike in general, and the sellers, based on what they're seeing, they're not willing to come down in price. Some of those are flips, and they had to pay up to get the house, pay up to finish it or expand it, and they're not willing to come down. So again, there's going to be, and then you have new supply in terms of foreclosures, evictions. This is all going to kind of convolute and complicate the next few months, and really the next 12 months as we start to look at how the housing market starts to shake out, given the backdrop of inflation and rising rates.